This is one of the most important videos you're going to watch about investing, and I'm not trying to be dramatic about that, but I really want everyone to really focus on staying in this video to the very end. There are so many things in the investing world that are said that are taken completely out of context, or you search for the results that fit the criteria. Warren Buffett always says that bubbles start based on a rational idea. Okay, now, if you've watched our channel before, we talk about return on invested capital at great length. Basically what this is it says, what return does the business get on the money that is invested in the business? And you can invest in a business in two ways: taking on debt, or putting your own money in, or having other investors put their own money in for equity. So debt or equity, right? And the return on invested capital, the invested capital is the debt and the equity that is in the business. And the return is the cash flow, the net income, the net operating profit after tax, whatever you want to call it, as long as you keep it consistent, because there are multiple ways in order to calculate the return on invested capital. However, and I'm not trying to pick on this person. I'm on Twitter, and one of our Everything Money community members who is doing some research for me, Dalton, sent me this quote today. And I'm pulling it up, and again, I don't want everybody to go attack this guy. I'm sure he means well. He's right on this one. Be wary using PE. I would change to, it could trap you. First line, he's right. A high PE or low PE can be manipulated in so many different ways. And a high PE could be justifiable with a high return on invested capital. Then he goes here. You could have paid 281 times earnings for L'Oreal in 1973 and still beaten the index. Okay, I didn't go back and look at this. 281 times earnings, I don't care how high your ROIC is. Something tells me that there was some reason why it was 281. Maybe they had a write-off that year, or they had some fluke year. I didn't go back and check it. So in full defense of this guy, I did not go check this. But here's where I think I take an implied exaggeration. This is exactly Charlie Munger's quote about return on invested capital. If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. He is correct. Now, not him, but other people have said to me, well, it doesn't matter what I pay, there's a higher return on invested capital, therefore I'll get that return, because that's what Munger says. No, he's not. Even if you pay an expensive looking price, for example, 25 times earnings. If you have two companies that both make $1 billion, one is selling for 25 times earnings, one is selling for 10, which one's cheaper? The automatic answer is 10, but not necessarily. What if the 25 PE has a 30% return on invested capital and tons of potential growth by investing back in the company, and the 10 PE has a return on invested capital that's lower than the return required by their investors? They're destroying value, and without any opportunities to reinvest, it's terrible. My whole point about this part, and again, stay with me on this video because it's really, really important. My point on this is just looking at one metric isn't going to do anything for you. My next comment is, if return on invested capital is all that matters, and you're going to get that return over long periods of time, what it says is it doesn't matter at all what the PE is. Does that really sound right? So then why not just pay 1,000 times earnings? Why not 21,000 times earnings? Why not 121,000 times earnings? My point being, at some point it matters. So I decided to go back in history and determine this. And the other thing is, if all that mattered return on invested capital, let me show you what Apple's at. Apple's return on invested capital average in the last 5 years is 38%. Why aren't you buying Apple at every price then? Why not? Last year, it's 53%. But Warren Buffett has shown that he's not buying Apple at any price. Fine, why not? Apple's currently at 166. Why not 1,660? According to this, then, you should just invest in any company. You should just go in, find return on invested capital, sort top to bottom, and buy the top companies. So I kind of did that. Now, I went to the last major bubble we had in terms of stock prices, and that was in 2000, because we have so much history there. We have from 2000 to 2023, 23 years of history, right? Now, what I did was I went back and picked the top companies in revenue. So like the biggest companies in the world. And I sorted them, and I looked at their average in the previous 3 years, prior to 2000, their return on invested capital, and their all-time going back to 1997 return on invested capital. So Bristol Myers, 37.4%. If you just were in 2000 and you went here and looked at this, what would you be saying? You'd say, oh, I should buy all these companies. Maybe so. And guess what? Look at their return on invested capital since then on average. Pretty high numbers here, right? 18.5, 26, 17.5, 17, all the way down. And then I went and did something, and I went and looked at their stock price since 2000. Pulled up their stock price since 2000. This does not include dividends. Look at these returns. The top one, Bristol Myers, is basically at the same price it was in 2000. The same price. Look at Microsoft. Its all-time ROIC is 26% over the last 26 years. It's 26% a year. They've made 7.5%. Guys, I'm not cherry-picking one company like that guy did. I'm looking at the top companies, the top 28, top 27 companies, whatever it is, 25. And I'm looking at all these down the list. Let me show you the averages. The average return on invested capital in the previous 3 years, 97, 98, 99, was 15.28. Going back to 97, the return on invested capital was 11.5%. And look at the average return per year, 2.97%. So what does this tell me? It tells me that if you overpay, it doesn't matter what the ROIC is. If you overpay by enough, your returns will be hit. Because if those of you out there who are saying, but that was the peak of the market. Well, wait a second. If ROIC is all that matters, it doesn't matter what you pay for the stock. It should still be high. You guys got to remember there's other things involved. One, if you overpay, first off, it doesn't matter what the ROIC is. You're still overpaying and it'll hurt you. Two, if they're not good capital allocators, a company can have a high ROIC, but if the CEO is reinvesting at terrible rates of return, it does not matter. Look at GE here. Look at GE and Citigroup. Citigroup has lost 9.5%. With a positive ROIC, they've lost 9.5% per year since 2000. Look at, where's another one? AT&T has lost 2.76%. Again, not including dividends. So add a couple percentage points in here for dividends. So you're still take your 3% to 5 or 6% on the high side. You're still way below the return on invested capital. Now, if we went back and looked, could we find some correlation between the best performers and the highest ROIC? My guess is yes. I would guess that these stocks with dividends probably did better than other stocks that didn't average 11.5% ROIC. That would be my guess. But the key point here is he says, even if you pay an expensive looking price, not any price, because like I said, if that was the case, I just went here, found the biggest companies, sorted, and guess what? Let's look at it this way. Pick everything above 20%. Right here. That's how many companies? 7 companies. This is their average ROIC is 28.27. Their average annualized return since 2000, 2.46. Guys, this is what I mean when I say you have to watch this channel. Nobody else is sitting there and explaining to you, listen, you still have to think about the quality of management. Now, quality of management to me, I used to think that when people said that, they want honorable people. I realized that's not what it is. What it is are they good allocators of capital? Once I made that realization, everything changed for me. I got so excited. Okay, I can see how they allocate capital. Are they buying expensive shares back? Are they making frivolous, stupid investments and acquisitions in order to show people they're being busy? That's what I care about. That is good management. When I look at this and see the top 7 companies on ROIC made essentially 10% of their ROIC in return over the next 23 years, it says to me it's probably a combination of overpriced payments on the companies and 2, bad capital allocation. That's why, look at Intel. Intel was 29.24 and still since then has averaged 17.5% ROIC, and they've lost 1% a year since 1997. Guys, if you don't see this, I don't know what to say. But for the vast, vast majority of you out there, I'm sure this goes, wait a second, this makes sense. Again, ROIC is important, but just like everything in life, if you overpay for something, you will end up hurt. Expensive looking versus expensive are totally different things. Totally different things. A $300,000 Ferrari that you can buy for $175, it's still expensive looking, but it's a great deal. It's still a great deal. because the average car is $50,000, but it's $175,000. It looks expensive, but it's not. Why? Because it's still a $300,000 Ferrari. That's the art of investing. That's what we're trying to teach here. We're trying to show you that there's more to the company than just about sitting there and going, well, we're just going to pick this and move on from that. By the way, I do believe there's probably some data, which I'd love to be able to find, where I just sort at top 20 ROIC companies and say, how do they do? My guess is they probably do better than the market or by lower ROIC businesses. But when I look at this, just saying that that's what happens, it's not, you're not going to get the return just because the company makes that ROIC. You still need to pay a reasonable price. And the reasonable price could look expensive in the market because it might be 20 or 25 times earnings because it has a long runway and a high return on invested capital. You know, a guy like Joel Greenblatt, I just read a quote what he said, that he said, listen, I like companies with fixed assets because if they have a fixed asset and a high ROIC, it tells me they have opportunity to reinvest back in the business. But you look at a company like Microsoft, how do they reinvest back in their company? They can hire more people, et cetera. They can do that, but it's not like you can make a factory that makes things more efficient. By the way, I'm not trying to knock Microsoft. I think it's a wonderful business at the right price. And they can hire more and more people and they can reinvest that way. But it's okay to have opportunity. When you have more and more opportunities to invest, you're going to do very well as a company when you have a high ROIC. But again, there's a price to be paid for that high ROIC, and that is the art of investing. Warren Buffett, supposedly, I haven't verified this, paid 30 PE for Coca-Cola and has made 11 or 12% of his money, including dividends. 30 PE. I don't know if that's true or not. If that is true, that's even if it's 20 or 25 PE, that's a high PE for a company that's going to grow reasonably, but not some leaps and bounds. So that's why you need to follow this channel. That's why you need to subscribe here. And the other thing is, please forward this on to somebody who needs to hear this message. Thank you very much for your time.